My name is Pete Sweeney. I'm Asia Economics Editor at Reuters Breakingviews, which is the financial opinion unit of Reuters News. Anyways, I'm really grateful to be here. We refer to Smartkarma a lot, and we rely on its analysts heavily, for when we're thinking about what is happening, especially these days. And I'm pleased to be joined here. I'm with Bharath Vasudevan with the Trust Society, Daniel Tabbush of the Tabbush Report, and Jason Daw at Societe Generale. And we're going to be talking about Asia risk. And I just wanted, everything. And I just wanted to start off with, to kind of kick off the conversation with a very general question that I'll pass around to you guys. But I'll start with Bharath. So, we know a lot of risks are out there, and then we know there's a lot of unknowns. At this point, what are the things you're most worried about, the unknowns we don't know yet, if you get my drift? Like, what are the wild cards that are still out there that could really destabilize markets and screw up people's risk models? Sorry.
Thanks, Pete, and thanks again to Smartkarma for inviting us here. It's a great question. Unknown unknowns, of course. It's 2 years in the line when we know for sure. But based on just what we have seen in prior crises and my own experience, the things that I would watch for, first is always liquidity risk, right? That's even in past crises. Losses are rarely the number one killer, but perception of credit losses leading to loss of liquidity, especially if you're a smaller player without a strong parent, I think is the one that I would watch out for the most. The second, credit loss itself, right? And everybody knows that losses in the peak of the boom are bad, but people often miss the point. If you go back to past crises, and another speaker alluded to it as well. Early in the bust, the first few months of a crisis like this, when you don't know what's happening, lenders tend to mislead risk. So I would certainly watch out for that. And last but not the least, I think any process imperfections will be really brutally exposed here, right? In this part of the world, lenders have often thrown people at problems, whereas actually you need technology and processes, especially as you scale back. So I would look for process risks and process imperfections that may get exposed. So these are the three unknowns that I would watch for, as it were.
Thanks. Daniel, you have anything to add to that?
No, that's actually very good. I would agree with all of that. I guess one thing I would add is looking at the off-balance sheet for a lot of banks. This has been a huge unknown in the U.S., where a lot of companies have drawn down on these facilities. Banks all of a sudden have a lot more credit on their balance sheet, probably to companies they didn't want to lend to. That has an impact on capital ratios, on risk-weighted assets. It also has an impact on banks' ability to continue lending, because all of a sudden they're taking on a lot more credit, which they didn't really envisage. Off-balance sheet is something that we often forget about, but in a crisis, it usually comes to the fore. So I would add that to the liquidity risk that Bharath was mentioning.
Right. Well, I mean, all the governments here are facing a really tough problem, and that they need to deal with a supply shock and a demand shock, and Lord knows political shocks coming down the pipeline. It looks like the U.S.-China trade war might be resuming. So, and they've got a very, very tough job. So obviously our sympathies to them. That said, we've seen some very different responses in Asia in particular to stimulus. Jason, I was just wondering if you could kind of give a brief summary of how you look at the monetary policies we've seen and how good they are at solving the first problem at hand, which is first let's get economies moving, and then we'll have to sort out the risk part and all these bad assets a bit further down the line.
Yeah, no, good question. Obviously policymakers have been, very fast and aggressive in their responses, not just in the developed world, but also in the emerging market world. And I guess the question is if those are those going to be effective policies? And I think, it really depends. They can be there from a liquidity standpoint, but can they really support growth to the degree that we need to see. And I think what we've seen in the current world, where it's a growth and deflationary shock, the demand for credit is probably going to be fairly weak going forward. Less discretionary spending, less capex by corporates, and with bank balance sheets coming under kind of broad stress globally, the capacity to lend does become constrained at some point. So, central banks can put a lot of liquidity in the system, but whether that gets to the end user is really a function of the demand side of the equation. And in some economies, we've seen that work well historically. In some economies, we have not seen that work so well. So it really depends on what that end demand for credit is going to be. And given how large the output loss is globally, and how economies are probably going to be at a below trend growth rate for a sustained period of time, it's unclear whether policies are actually going to be stimulative to the credit side.
Well, how would you grade, for example, China's attempt so far? Because a lot of people are looking at China as like first in and first out of kind of the COVID-19 mess. Obviously, they've got a bit of a stimulus package going underway, but it's not as overwhelming as it was after the global financial crisis. It seems a lot more attempting to kind of balance their existing bad debt problem and their desire to avoid building junk infrastructure. And yet, and we've actually seen some fairly decent, surprising performance in credit flows, especially in total social financing, which includes like the shadow banking side. How optimistic are you about the Chinese package, which obviously would support demand in a lot of the economies next door?
Yeah, I think in the China context, there's two things to consider. One, the efficiency of credit into the economy has fallen quite substantially over the past decade. So the credit multiplier has come down. It doesn't mean that if you throw even more money at the problem that it will be helpful and supportive. But they, as you mentioned, they are balancing a longer-term deleveraging campaign with needing to support economic growth now. And the credit impulse has actually been, quite sizable. And I think what's unique in China's case, maybe versus other economies around the world that are more market-oriented, China has the ability to, force a lot of credit or infrastructure stimulus into the system if they want to. So, they want to take it slow. That's probably a prudent approach by them. But I think, the message should be that if they need to, they can ramp up stimulus a lot more going forward.
Let me ask you, Daniel. So you've been looking at the banks. What do you think about the state of Chinese banks in 2020? They've been expected to run down their risk buffers a little bit, but they had some pretty hefty ones. The reserve requirement ratio has been coming down. And yet there's Bank of Gansu is getting a bailout. There's a lot of concern on the lower end of things. What's your take on how this package is going to play out for these guys who obviously are stock market heavyweights?
Yeah, I think Jason's points were highly relevant. Probably the China system is the most easy banking system to control, to force banks to actually lend. And we did see this in the global financial crisis. We did not see that in TIPS markets, for instance, nor did we see it in the US or in the UK. It's very difficult in these other economies, in these other systems, to actually force banks to lend. They don't want to. They're actually risk averse in this environment. So I would say that the risk is that they are forced to lend. They have to take over weak companies. They have to provide credit for weak companies or even consumers. And this will have an impact on capital ratios. It should have an impact on credit costs, on provisions, and on bad loans. Of course, when we're talking about China, we always have to think that the stated numbers are probably not quite the same as actual numbers, especially with respect to bad loans or credit costs.
Well, okay, and this brings us into the shadow banking side of the equation, I think. Bharath, India also has like some problems in its banking system, and a lot of SMEs, a lot of the problems that the stimulus needs that China has. But I mean, from my first glimpse at the stimulus package, it seemed relatively underwhelming, which suggests that the government feels quite constrained in its ability to print money or whatever, that it's worried about its currency and so on. How would you describe the state of India's stimulus?
So just in terms of the non-banks and the money that the government intended to flow through them. Interestingly, India cut the cash reserve requirement by 1%. There were rate cuts. There was all these LTRs, LTROs. So there's a lot of money, but none of it was really getting transmitted, right? So much of the monies, I think it was not accompanied by the credit guarantees. So a lot of the banks took the money from the central bank and deposited it right back with them. So that's one part of the problem. The other thing that India was facing, right, whether direct lending or even through money markets, right, there's a lot of credit aversion today, and there's a lot of uncertainty around credit outcomes, right? And for sure, having a moratorium is helpful in many ways, but it clouds the outlook, right? And it clouds the knowledge that lenders have about whether a borrower is viable or not during a moratorium period. So therefore, there's a high degree of credit aversion, there's a high degree of fear, and consequently, while there's liquidity with banks, it's really not flowing to the end user directly or indirectly. And that's true for India. I suspect it's true for many countries in the region as well.
Well, what other emerging market are you more worried about?
So from our
How do you feel about Indonesia, for example?
Yeah, I think Indonesia is a similar example, right? Again, if I look at Indonesia's non-banking system, you can think of them as three categories. The non-banks that are protected, that are in the same family as a bank, right? Either as a subsidiary or otherwise. I think they have access to liquidity. Indonesia also has some large business families and consortiums which have non-banks. They too would be fine, but there are a lot of single standalone non-banks. And Indonesia has almost 150 P2P lenders, right? Many or most of them actually perhaps don't have this degree of parental support. So I suspect they would face challenges.
Daniel, I think you had something to say. What?
Yeah. One of the points is interesting that Bharath was raising. Even where RBI has been lowering rates, actually banks' premium on the rates charged has been rising. So this has been a problem for years, and this goes to the risk aversion, especially in a system like India where bad loans are so high. But another thing this reminded me of when you're talking about the moratorium and unknowns at the beginning is can't pay, won't pay, and can pay, won't pay. They're very different concepts, and the problem is when you have this kind of environment, a lot of companies which can actually service their loans, they're just going to decide not to. They think, why should I? Everybody else is not. A lot of companies are not. They're not in trouble because of this shutdown. And we saw this in Asia. We saw this in the global financial crisis. And this could be another big risk sort of out of left field for bad loans.
So where do we see the shadow banking sector? What role are they going to play, for better or worse here? China went to great lengths to suppress the function of alternative lenders, which was seen as being, hiding all sorts of systemic risk. Fair enough. But we did see kind of a surge in some of these activities. And obviously, in China, as you said, Daniel, about like the nature of the state, also tends to discriminate against private firms, and then the shadow bankers will come through and help out. Do we see this as a positive thing? Should governments let the non-financial institutions back in, or encourage them to step back in, or is that going to do more harm than good? I leave that open to anybody who wants to talk about it.
Well, I guess, I think, right now it's probably a little bit risky, partly because, the shadow banking area is going to face, similar constraints as the banking system. Later on, if the growth recovery is slow and we're talking 1 or 2 years down the road, then yes, governments may need shadow banks to step up in a way to help. And if the traditional banks can't, fill that void on a longer term basis. But right now, that's probably not the case. And I think, just related
hold on, can I just pause you real quick?
Yeah.
So, and this is because you just walked by one of my pet peeves, and I love talking to banking people about this. But like lending, all the governments are like, we need to lend to the small businesses, small and micro businesses. They're these huge employers, blah, 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 but any sane loan officer in any country is going to try and steer around these small guys, right? They're expensive to due diligence, like they can just vanish in thin air. And so, like the Chinese bankers are, everybody beats up on them for not lending to these guys. But I don't know any place where you would ordinarily be enthused about lending to the people, right, who need the credit most right now.
Mm-hmm.
I mean, but now you have a push, like a policy push to say, put them on your books. And that just seems really dangerous for a big bank. And it seems like this is the thing where the small guys, who will charge higher rates, sure,
Yeah.
but will be in the market and know better what they're doing. I mean, India has had a lot of innovation in this space, China, a lot of the emerging markets. And I just, how do you see the large banks stepping in and really doing an efficient job of propping up, like restaurants and I mean, they can do airlines, but the little guys, they seem particularly ill positioned to help. And it seems it would do a lot of damage to their balance sheets if they tried. Am I missing something?
I'll just make one quick comment and then I'll pass it along to the other panelists. I think, it's a valid point. It's just that right now, both banks and shadow banks are both, experiencing balance sheet pressure from credit risk. So, as far as who has the capacity to lend going forward, traditional banks probably more so because they are the beneficiary of government support. So you run into a situation now where you kind of have the haves and have-nots in the liquidity side. And if the traditional banks are receiving that support from central banks directly, they have more of the ability to do it. Whether they will do it is an open question. Whereas the shadow banking side doesn't get that liquidity directly and could be facing similar type of balance sheet constraints. So at least right now, it makes sense from what you said, but it is quite difficult, I think, in the current environment where growth is still very weak. But I'll pass it along to the other panelists.
I might just add, when you think of shadow banking or just say non-banks, it's quite a broad spectrum, right? And any of the countries that we work in, there would be a handful that are exceptionally well run, typically run by former bankers as well. And they just have the efficiency of leading with technology, especially, and process with a lighter regulatory touch than banks. And I think it's very helpful to have them continue to lead the way because they often are the innovators and the path makers in new domains, especially when you get into the harder segments to lend, the new to credit segments, the smaller SMEs. That said, many of the points when you say shadow banking, for every one of those lenders that I talk, there may be 50 or 100 really small lenders who are weak on balance sheet, and they may also not be the best in terms of customer protections. They may be on the borderlines of regulatory or usurious lending. So it's really a fair balance that one has to walk. But I personally believe that the best non-banks have a very important role to play, right? And if you believe that coming out of this crisis, you're going to see a significant change in the way lending is done and the adoption of digital lending, then for sure, the best non-banks have a role to play here.
What is this going to do to risk modeling? I mean, everything we've been talking about, like there's a lot of moral hazard floating out there probably, and it's going to get worse as governments, keep on throwing money into this. I mean, like, how are banks positioned to kind of like price things properly and get a good view of how to price things, or are the old models just need to be junked and try to start from scratch? I don't know.
So it's a great question. I mean, I was formerly the risk analytics head for a very large non-bank, so I'll take my shot at it, right? So it's true that the world has changed significantly, and that means all the dislocations we are seeing will impact all credit decisions, including all the statistical models that banks have, right? And unfortunately, we don't have the benefit of a time machine, so you will not know exactly what the correlations are, right? And you will not know that for 18, 24 months down the road. But one has to act now, right? And good lenders, I think even in past crises, when historical correlations, for example, in 2008 in the US between the housing variables and risk broke away, the people who were successful did two things. They made smart judgmental calls, right? Which meant in this, for example, be much more prudent while lending, let's say, into hospitality and airline supply chains. That's an example of a prudent call. The second is to recognize that risk is probably gone up 50 or 100% versus what your models are telling you, to just increase your assumptions and tighten your thresholds confidently. And last but not the least, again, in the context of moratoriums, many of the assumptions around risk, especially if they are based on repayment track record, whether it's credit bureaus or banks' behavioral scorecards, go away. So I certainly would recommend significantly looking at alternate data, and there's a lot of that these days, but really look at alternate data as a supplement to your existing models. So smart cuts, prudent increase in risk assumptions, and alternate data. Those are the three things that I would say lenders have to do. You can't just throw away your models because you don't have an alternate, and you won't have predictive alternate models for about 18 months is my guess. So you have to.
I'm sorry, I didn't mean to throw up a straw man that you'd actually.
Makes sense.
Well, in terms of due diligence, it just struck me interesting that Pepsi did a deal in China, and it was right in the middle of the, the lockdown quarantine, and they had to do some of it remotely, right? Which is not generally what you want to do in any M&A deal across a border. How are these banks technologically prepared to do all these ordinary, in the midst of this push to kind of lend more, and yet you've got all these restrictions on your ability to fly around and kind of shake hands and kick the tires. And feel free to mention names of the banks that are prepared, the lenders that are prepared to kind of do this sort of due diligence work without getting on an airplane, in terms of their technology, in terms of their skill set. I'd love to hear about the work from home, DD, KYC stuff. Anyone?
I'll just give a few points, Pete, on this, because it goes back to a lot of what you're just talking about now, that the companies which need credit the most will be left behind in all of this. And the largest lenders will probably focus on the highest quality companies. And we've seen that in the past. We'll probably see it again. So that is another risk, an unintended consequence of all this. The non-banks are then left with the most needy of customers, and probably will raise pricing far too much, which won't help them at all. But this goes to your point on due diligence in this environment, where you're probably going to have a lot more localized lending being fulfilled than any cross-border, cross-province, cross-country lending that was going on in the past. You'll have generally less lending, as we've all talked about all this whole panel already. But you can just actually ratchet that down by region. And
deglobalization of credit in the short term.
To a degree, but remember, most of these countries have plenty of domestic credit, right? They have enough credit in their local system. So instead of sending it out, like the Japanese banks have been expanding outside of Japan for a very long time. Maybe that's more limited now.
Yeah, do you see the Japanese? Well, there's an interesting transmission problem. I realize we have like maybe 6 minutes left. So, but like the Japanese approach is quite interesting and seems to be not that successful. We had some huge headline figures.
There's not much in Japanese banking that is successful, really. But yeah, you have an aging society with X growth, and they've been expanding abroad for years and years and years. And now it's really hurting them. You're seeing the banks with most of the foreign exposure, with the worst kind of provisioning, the worst kind of bad loans than any of the very, very regional banks. And that could be a theme across all of Asia, where the plain vanilla, very domestic banks are the ones that do okay. But like we were talking about at the very outset, the ones that are not leveraged, that don't have liquidity risk, they have a good deposit franchise.
All right, final round of questions. So there's the debate about the V-shaped recovery or the K-shaped recovery or the whatever shaped recovery is coming up. What are you guys, I'm just gonna go around the hopscotch square, as it were. What are you, if you had to pick like a couple of key indicators you would look at to say, yes, like things are coming back online, like this is a definitive sign of a turnaround, what would you point to? I'll start with Jason. What are you watching?
Well, there's obviously your normal kind of high frequency economic indicators, but I think from a credit perspective, there's kind of three things. It's to see a sustained narrowing in spreads. That'll tell us at least that investors are perceiving the risk better going forward. The default cycle, which tends to peak after we've had a move in spreads or after the activity starts to improve, but at least will provide confirmation of where we are in the recovery and possibly how strong it'll be. I guess third is, what's happening on the bank lending side. So in a lot of countries, you get fairly, reasonably timely, data on private sector credit. And, that's going to be important, because if you don't have a decent credit impulse happening through the banking sector, then the degree of the economic recovery is fairly limited. There's only so much economies can grow organically without that push on the credit side. So that'll probably be important to determine whether we are in a stronger V, whether we are in that W, an L, many different types of letters. And I guess the last point is just simply, is there a semi-permanent or permanent change in consumer and business behavior going forward? And if there is, then the growth recovery could be quite sluggish.
All right, Dan, you got 2 minutes.
Yeah, I would agree with that. I think credit growth is possibly the most important thing of all, but I would also look at credit costs. So the impairment charges that banks make, usually there's 2 or 3 years of very, very high charges. It is not a single year event. It's not an interim event. And when we see those things coming through, 2 years of elevated credit costs and improving credit growth, then maybe you can say you're past the worst of it.
Bharath?
And if I had to add just all great points, at heart, this is a medical emergency. So CROs would have to get conversant with the progress of remdesivir and favipiravir, things they never thought they'd have to talk about or follow. But I think the medical emergency, whether it's a vaccine or a cure, people need to follow that pretty closely. On the manufacturing side, I think the gross capital goods formation or the PMI index, whatever is the metric to track investment when that starts back, whether it's 12 or 18 months, I'd keep a pretty sharp eye on that. And for a couple of markets, certainly markets like India, the monsoons matter a lot every year, right? You don't want a second shock in terms of macro factors. I would keep an eye on that. That has an important.
All right. Well, on my personal one, I'm watching on the medical front, I'm watching what happens with the mask manufacturers. I think there's been a huge surge into mask manufacturing. There's a huge price bubble. So when I see that start to deflate, I will start feeling a little bit better about things. But right now, all the investment speculation into these lines of business that only benefit from bad news, I'll look for negative signs for them, and that will be positive for me. Anyways, look, guys, I'd really like to thank you for chatting with me. I thought that was quite interesting. I hope our audience out there enjoyed it. And I'd like to thank Smartkarma again for having me and us on. And that's it for me. Can I hand it back to you, Pranav?